Hi, I'm Ian Kamlani,
My name is Hayden Lucas.
and we are the Rice Restructuring Group, and today we'll be presenting on office properties income trust in our turnaround plan. So quickly, I'll just walk you through the table of contents. We're going to start off with a company snapshot and overview of how they've gotten into this distressed situation, a business turnaround plan, and then we'll dig into the financials and talk about how we would actually restructure their debt.
Yeah, thank you, Ian. So starting off with the Snapchat and company description, Office Property Income Trust, or previously its ticker being OPI on the stock market, is a publicly traded office REIT under the RMR umbrella group with a portfolio of roughly 150 properties totaling about 20 million square feet within the US. The company primarily serves corporate and government tenants. Historically, this government focus provided stable cash flows and long-term leases. However, over the last decade, OPI shifted away from that model through acquisitions, notably of Pomatic Realty Trust in 2017 and Select Income REIT in 2018, which we'll be discussing later, which diversified the portfolio but also diluted credit quality and tenant stability. Government tenants once accounted for over 90% of rent in 2016 compared to about only 25% today. You can see that new lowered percentage of U.S. government being the tenant in the diagram below, as well as the location of properties on the bottom right, as well as the decreasing and now negative free cash flow since 2022. Yeah, so now going into the situation view and the drivers of financial distress, and overall like the evolution of this firm. So starting out, first, OPI's historic strength, its long-term federal leases eroded after the REIT diversified into more cyclical corporate assets. The 2018 merger with Select Income REIT doubled the portfolio, but added many short-term private sector tenants with higher turnover and lower renewal probability. Second, as the pandemic hit, the office sector was structurally redefined by remote work and government downsizing. Utilization rates never fully recovered, and OPI's occupancy dropped from the high 90s pre-2018 to the mid 70s today. We'll be discussing this more later as well. Third, the company's debt structure became a liability. During COVID, OPI refinanced and expanded using rate debt to preserve liquidity. When rates rose post 2022, this decision translated into a surge of uh, new interest expenses, rising more than 40% in 2 years. Meanwhile, CapEx doubled, roughly 100 million in 2021 to over 229 million in 2023, largely due to improvements and lease renewals in a soft market. Some key highlights I want to make on this slide is the decrease of over 50% of government tenants from 2017 to 2018, and overall the credit impacts that had from originally being, investment grade with triple B minus in S&P to now being double B plus, which is a speculative nature. Yeah, and then so with this more macro environment sort of sector headwinds, from a broader market perspective, OPI challenges mirror the pressures facing the entire office REIT sector at the moment. However, unlike many other companies who chose to diversify away from the space, OPI really leaned into the space with diversifying its portfolio. However, not with stable tenants, but with more variable low credit tenants. Office demand has really structurally reset. Utilization is holding out at only 55% of pre-COVID levels, and the national vacancy rate has climbed to nearly 20%. Both corporate and government tenants have actively reducing footprints and consolidating into newer and higher quality buildings. On the capital side, we've seen a repricing of risk. The 10-year Treasury yield has risen around 1% in 2020 to over 4.5% today, which has widened often cap rates by roughly 200 to 300 basis points and reduced valuations by up to 45%. This has, of course, opened the refinancing risk, and it's now the biggest pain point within OPI. Many REITs, including OPI, have moved from unsecured to secured borrowing, often at 7 to 9% interest rate. Liquidity windows are tight, equity markets are effectively closed for the company, and lenders are prioritizing asset classes like industrial and data centers over traditional office spaces, especially a company like OPI that's so heavily diversified. Finally, operational costs are rising. Tenant improvement allowances and leasing combinations are up 25 to 30%. From pre-pandemic levels, and maintenance capex continues to climb as older assets need reinvestment to stay competitive, as well as the idea that OPI had to change some of the Class B assets that they acquired in the mergers into Class A assets to then charge a higher price. This backdrop makes it extremely difficult for a highly leveraged office REIT like OPI to refinance or stabilize cash flow. The macro isn't just cyclical, it's a structural repricing of office asset class. And with all that being said, I'm going to hand it back to Ian.
Yeah, so the first thing we're going to look at here is the business plan for turnaround. And this is on an optimization level, not necessarily on a debt level. So the first thing we're going to want to do is divest non-core and high capex properties. So, we're highly levered. And as a company, we think it would be best to first sell underperforming and capital intensive assets that are stressing operations. And this will hopefully improve our margin profile as well. We want to reposition into growing markets. Once we've delevered a certain amount, we want to expand into the Sun Belt and secondary metros that are growing quickly. And spend on new offices that are ones that people are looking to move into to capture tenant migration trends. The second thing we want to do has to do with leasing and occupancy initiatives. So this would be accelerating lease ups. So we would want to offer flexible lease terms, targeted concessions, and tenant improvement incentives to drive up occupancy rates. This is an issue we've been facing as a company. They've been facing as a company is occupancy levels have been dropping. And so we are bullish on the fact that people are going to go back into work. And so we're looking to target those people with flexible leasing terms as well. Tenant diversification. We want to expand it to healthcare. We want to expand it to education and professional services, especially in fields that we are confident in the fact that are going to stay in person working. And so those are some of our strategies. And the last thing would be expense management and operational efficiency. We want to reduce SG&A and property operating costs, and this can be done through selling a lot of our highly expensive properties that aren't generating cash flows, and renegotiating service contracts as well. We think energy and efficiency investments is something that we could look at to lower operating expenses, such as LED retrofits and smart HVAC systems that will lower costs on a property level. And now that we've addressed kind of the operational issues, let's kind of dive into the financial issues. So take a look at the capital structure overview. Starting at the bottom, actually, let's take a look at the 21.5% variable debt. And as Hayden had mentioned, in 2021, the company had taken out a lot of floating rate debt. And at the time, it had only been 1.5%. As you can see on the revolver, that SOFR rate is now up at 4%, and that is a hugely impactful cash interest burden. As well, you can see that this company is highly levered. They're 10.7x levered to EBITDA, with a lot of it coming due in 2027. I would also note that in the market value, you can see that a lot of the unsecured senior notes underneath the priority guaranteed are trading at 10 cents on the dollar or trading at 10. And so that's really showing that creditors understand that they're in impaired class and they're not going to recover. And so those are some of the issues we're facing, is that this debt burden is not going to be able to be fully paid back. And so let's take a look at the valuation summary. So starting at the top, we implied we first used a DCF. We had a low end range of 1900 or 1.9 million and a high range of 2.2 million. We used a WACC of 8.2% and got this range by changing the terminal growth rate from 2% to 3%. That's how we generated that range. The second valuation method we used was a comparable companies analysis. So we took four other distressed office REITs that were kind of going through similar issues and tried to see where our EV to revenue, EV to EBITDA, and other multiples were trading in comparison to them. And so, as far as EV to EBITDA went, we used a 10.2x to 11.4x applied LTM to their last 12 months EBITDA. And so we got this range. And then the liquidation valuation, we put together all their assets with certain recovery percentages from low, medium to high. Um, and figured out if we went through a fire sale, what would the company be worth? And we also completed a precedent transaction analysis, but we ended up not including it in our implied range. And this was because there was a lack of acquisitions in the office REIT space that accurately represented the distressed situation that our company was in. And so we felt it would skew the enterprise value, especially for the premiums that are spent in acquisitions. And so we decided not to include it. And all the models are attached in the appendix. And so moving to the next part, our waterfall analysis. So starting at the top, we assume an implied enterprise value of 2.285 million, or billion, sorry, and we add back our cash and equivalents. And so we see that we have about $2.3 billion available to investors. So starting from the top down, we see that all our mortgages can be paid off, and all the secured debtors will receive an 100% recovery. The issue gets down to once we go to unsecured debt. So the priority guaranteed notes will be fully paid down. But what was left, the 340 million, is not enough to cover the rest of the unsecured senior notes. And so we found the pro rata share of how much should be awarded to these creditors. And we find that that is the impaired class, only with an 88% recovery. And as well, the equity value has fully been extinguished, and so they will not be getting any recovery. And so, with that being said, with the waterfall and with the evaluation, what are our plans to, restructure this company? And so, the first thing we're suggesting is a debt for equity swap of the secured senior 9% notes. So, we would convert a portion or ideally all of the secured 9% notes into equity, and this would be to deleverage the balance sheet. And the reason why we picked that is because this is the highest coupon piece of debt that we have on our capital structure. And that cash interest burden is really, really killing the company. And so this is something we definitely want to extinguish. And we would do that swap to match a yield to maturity similar to what the bonds would get. And then we would potentially consider offering a PIK interest for the unsecured senior notes and push out those maturities while keeping them, tuned in. Um, but essentially, that would be to compromise and preserve liquidity while we need it right now. The second thing we would do is acquire DIP financing and securing it by a priming lien senior to all our existing debt. This would provide some more liquidity that is much needed to fund operations, to pay for the restructuring expenses, payroll, and everything else we need to do to stay in business. And this would give us a further runway to fix operations. And lastly, kind of mentioned before in the business plan, but we would sell off all non-core and high capex properties. Right now, we really, really need as much cash on hand as we can to manage with the debt burden. And so even if we need to sell these at a discount, selling capital intensive assets to generate the cash for this restructuring is very important. And so we would use the proceeds to repay DIP financing obligations or other exiting financing options. And we would streamline the portfolio to just our highest cash generating assets and then over time rebuild up that portfolio. So now just diving through the appendix, I'll just flip through some of the models that we built. But that is our presentation, and thank you so much for listening.
Thank you so, so much.